Portfolio Builder members, welcome to our Tuesday trade alert. I apologize for being about 15 minutes late today, but we did come off with yet another win. We've been on a winning streak. Today we will review our profit and loss week over week on the Tuesday play. We'll take a look at our total portfolio strategy and also dive into what all this fuss has been about in terms of the momentum trader blow up yesterday and today. So let's get started really quickly by just simply reviewing the previous trade alert and how we came off with the profit. All right, so let me pull up last week's trade. So last week, the Facebook security was trading at a price of $184.18, and we sold to open the September 13 190 call option. That just means we agreed to sell our 100 shares of the Facebook for $190 a pop, and we would get to keep, if this was exercised, the $1.13 per share that we collected by selling this call option contract. So that's a pretty good deal. We can make about $6 on the upside of the security and get to keep the $1.13 we collected in the credit. Now, what's the other side of our trade alert? Well, we know there's a lot of risks in the market. There's $16 trillion of negative yielding debt, which may seem absurd, but is definitely a warning indicator that things are not completely okay around the world. We've got North Korea flying off unidentified missiles over the last 24 hours. We've got Taiwan buying a bunch of F-16 jets. And we've got Hong Kong protesters rioting in the streets, breaking cameras, and wearing Make Hong Kong Great Again hats, asking Trump to come save them. So things are certainly risky out there, and that's why at all times we recommend having a put option below whatever asset it is that we're trading. In the Tuesday play, we're currently long Facebook. So this setup essentially cut off our profits if Facebook had gone all the way up to 190 this week. And in the same breath, if something really bad had happened and the stock market started to crash, we wouldn't really care because our worst scenario is we get $177.50 per share of Facebook we own because we were smart enough to buy crash insurance. And in this setup, what we're doing is we're allowing Facebook to appreciate, to deliver the profits, and we're only using the call options we're selling to finance the crash insurance. So from my point of view, it's foolish to buy call options all the time, which is what we're doing week over week. We're selling the call option to the speculator, and then we're using that income to pay for crash insurance. Now that crash insurance is not a speculator. That's a huge Wall Street bank who's underwriting put options underneath the entire stock market. And so from their point of view, they don't really care if they get assigned and pick up some shares of Facebook. They'd probably be more than happy to add that to their portfolio anyhow. But most of the time, they can sit there and sell those put options and generate huge returns for their bottom line in doing so. So all in all, it's a great setup for pretty much everyone involved. Probably the person who typically loses will be the call option buyer who we're selling our call option to. And so let's talk about how to audit the returns on your own so you can see how well you're doing and make sure what we're preaching over here is accurate. So again, last trading price, $184.18 in this screenshot. Now in my calculation, I actually used the $184.30, which is what it cost for Facebook shares when we closed it, the previous trade. We've been trading Facebook for quite a while now, about 4 weeks. And so let's look at what happened. Okay, so we go to today's trade alert, and I'm not going to show you what we're recommending today. What I will show you is how to close out last week's trade, and then we'll talk about the big picture. So you can see that Facebook did indeed go up. The last trading price as of closing out the trade was 186.77. And to get out of the trade, we had to buy to close the 195 call. Remember, in the previous screen, we sold to open. So this is really all you need to know to follow our program is we start off trades by selling to open a call and buying to open a put. And you can see the debit was 22 cents. So after taking in $1.13 on the short call option and then reinvesting that to buy the long put, we ended up having to pay about 22 cents total for downside protection. Pretty good deal from my point of view, because I think that Facebook will go up, but not more than 190. So let's see what happened. It traveled up a little bit to 186.77. And so now we can get out of the option collar for 6 cents. So again, we had to pay 22 cents to enter the trade, and we had to pay another 6 cents to get out. So let's see how the math works on that. And there you go. Facebook went up by 2.52, and that's actually shortchanging us a few cents, depending on whether you wanted to look at the price of when we closed the trade or we re-entered the trade. So I could arguably throw an extra 18 cents on that. Who's counting the pennies? Okay, now let's look at the option collar. We paid 15 cents to get into it, another 6 cents to get out. So we did give up 21 cents of our profit. The net return is $2.31 a share. In this portfolio, there's 900 shares. That's $2,268 of income from Facebook in a week. Now, if you do that sort of return annualized, it's 64%. And real quick, let's look at the picture. Generating income is easy when you have a moat around your castle. Well, I hope what you're learning from our strategy is that's what we're trying to do. We're trying to build you a moat around your castle. Not only are the specific securities we pick typically have a moat around the castle. Think about the SPY ETF represents America. America has all of the oceans surrounding it, protecting it from the rest of the world. If we look at Facebook, the current trade alert today, well, guess what? It has absolutely no competition. Zero, zilch, none. It has absolutely nothing in its way to continue piling in profits from its social network and from all these phone apps it's bought. So I really like Facebook right now. We'll talk about what we're going to switch to in the near future on our Tuesday trade. And it was going to be Microsoft, but there's some pretty interesting news flowing out about China possibly buying agricultural purchases, which may lead me towards a different pick next week. This week is, again, Facebook. I don't want to speculate on things that might happen, but if something like that were to happen and China did start buying up agricultural products, we'll look at what my hot pick for Tuesday would be. So beyond picking the right securities, you got to remember we always have the put option below, and we're taking candy from the baby by selling the call option to finance our downside protection. So we have a very, very safe setup. Our castle's not going anywhere, and we can sit here and crank out income over and over and over again. So this is our Tuesday Trade Alert return from the Trade Alert document. If you do go to your email, you can find all this information and click on the track record link so you can go through all of our trades yourself. Now again, this is the Tuesday play. Its total return is now at 19.4%, but its year-to-date return, if you exclude the loss in December, is up 24.8%. So this portfolio has been doing very well, and we'll talk about what I expect to see in this portfolio moving forward. Now, I do want to note that this is just a little piece of the puzzle. We have essentially a set of portfolios you can follow, but the best strategy is to combine them all together. And so you can see my total strategy here is to have 38% of the portfolio trading the SPY ETF. I have 12% trading the Tuesday pick. That's where I'm hand selecting the best stock for our goal. Now, our goal is not growth. Our goal is to generate consistent retirement income with extremely safe, conservative strategies. Now, the metals portfolio, it's a buy and hold. That portfolio has had a huge return this year. Right now it says 53%, but I do want you to know that I've diluted it by about 200%. So this return's actually over 200% to date. If I had not been piling in cash about every 3 months into that portfolio, as we saw the central banks go from a very hawkish, responsible mindset in December, where they had plans to tighten the balance sheets, to get the balance sheet much lower by trillions of dollars, and to raise interest rates about every 3 months by a quarter of a basis point. So anyways, all of that went right out the window with just a quick little crash in December, and now they've been slowly but surely going into the mode of going towards zero interest rates and buying up government debt. Now there's a big event this week with the ECB. Lots of speculation. They're expected to drop rates and start up something like a $40 billion a month QE program, where they may not just buy bonds, they may actually buy some equity. So we'll see what all comes of that. Next week is the Fed speak. They'll probably be the most hawkish of all the central banks, but still follow suit. And so all of this leads to, as long as China and U.S. aren't in arms and trying to kill one another, it leads me to believe that stocks are going to have a huge rally to close out the year. So that's how we're playing those first three. Now, the safety play is the bond portfolio, which we trade exclusively on Thursdays, and it's had a great run. It's actually up more than 12.6%, but the way this calculates it doesn't take into account that we have some put options that have been betting down on TLT for the last 2 weeks that are up tremendously. So this will actually continue to outperform the SPY as the TLT has been on a straight rip higher. And we'll look at the TLT. It has had a nice sell-off, which we did predict and bet on, which has added a lot of profit to our portfolio. So we'll talk about when we'll switch the flip back to betting up on the TLT. But again, if you do combine the trades, it makes it very hard to lose. And that's because typically, not always, but typically, bonds go up, stocks go down. Stocks go down, bonds go up. And in general, they climb together. So that is the general strategy that we recommend, and that also has a little bit of gold to fight against the risk of inflation. So what happens when banks print too much money? You get inflation. Right now, there's not a whole lot of inflation in America. We are seeing a ton of it in China, the second largest economy, so that could potentially start to spread as they continue to print more and more money, devalue their currency, and then we're seeing everybody around them forced to do the same action. So quite likely, one way or another, we're going to see inflation. Now they're talking about, at the ECB, instead of just, and this is probably not going to come out this week, but I was listening to a Macro Voice podcast about this, and they're all figuring out how to essentially shortcut lending the money straight to the bank with QE, and instead perhaps finance part of the government's obligations for social financing. So now all of a sudden all your welfare things are being paid for by the Fed and not by tax dollars. And so that's your modern monetary theory coming to play in cahoots with the central banks. Now, if you do want to get today's trade alert, I highly recommend you call Dean. He's an expert trader. He's made tons of money in stocks and options. He follows our product. He also does his own trades. He's very successful. He can really help you get your ducks in order and make sure that, going into retirement, you don't have a super risky trading allocation or set of equities that could really burn you when things do go haywire. So even though we are forecasting potential for a huge run-up in equities, this is all at the caveat that it just takes one Trump tweet to change the whole situation. Also, inflation could change the whole situation regardless of what Trump decides to do with this trade war. So again, if you want to really just make your life simple, easy, consistent, generate income with the moat around your castle, protect your assets, call Dean, 505-322-7515. We'll activate your account, get you today's trade alert, make sure you don't miss out on tomorrow's, and walk you through the different allocations we recommend. Now I'll summarize it for you real quick before we jump into today's materials. But real quick, let's just stop and see if we have any chatters today. Oh, we do. We got Scotty. Hey, Scotty, how's it going? Dean says that's 5 for 5 on the last 5 trades. Yeah, we're on a hot streak. Now, normally I like to let the bonds lose while the stocks win, or the stocks win while the bonds lose, so they can act as a insurance policy against one another. But over the last 2 weeks, I had such a high conviction of what was going to happen that we bet down on bonds, up on stocks, and it sure has paid off nicely. All right, so let's look at some of the trade allocation setups we have. One that makes the most sense if you are able to trade 5 times a week. It's a 2-minute trade. My dad says it takes him more time to take out the trash than it does to do these trades. And so if you did catch the beginning of this live stream, you saw it's literally sell to open a call, buy to open a put, and then we buy to close the call and sell to close the put. Repeat, rinse, wash. Think of the Karate Kid, wax on, wax off. We're going to be doing this over and over and over again. It gets a little bit repetitive, but it really works. Oh, hey, Scotty. Yeah, I don't know if you get audio on the live stream, but Thursday we have a live webinar where we do turn on the mics so we can all chat with one another. We invite some of our members who have been following for most of the year in to just talk and chat, tell their experiences. Of course, we'll probably have some pretty good reviews this week, but we don't always have such a hot streak of trade alerts. So this allocation really makes a lot of sense if you are able to do all of the trades Monday through Friday and have $100,000. Now, if you use a broker like Interactive Brokers, you can put a measly 30 grand in there, and they'll give you at least $100,000 of buying power. Now, for most advisory products that I've helped represent, when people would come over the last decade, I've been doing this. If they were to come to me and say, hey, should I use leverage or margin? I'd say, hell no, that's crazy. But with this program, we're playing it as safe as you possibly could get. We got put options below all of our assets, and we're financing it for free by selling call options. And then we have a bond equity ratio that just all combined makes it extremely hard to have a bad week. Now, if you want to do a little bit easier setup, but you would still be okay with 4 trades a week, then check out this allocation right here. It's $66,000 to build it. You're going to put 30 grand into the SPY, 30 grand into the TLT. We're currently recommending a 10% position in gold. And I'll tell you how you could spice that up a little bit more, but if all you did was buy 200 shares of GDX, you're doing very well. Now, a lot of people are asking me, do you think this is going to be a weak period of time for gold with equities rallying? Maybe, but maybe not. It depends on how dovish all these central banks get, and if we're really going to have some sort of truce in the trade war for the next several months. And so from my point of view, I'm more than happy to have 10% of my portfolio holding gold, letting the swings go in either direction against me or with me, and maintaining that 10% allocation. And when I show you the return on that portfolio, it's almost obscene how high it is, but it has had to hang on to some 12% losses in a single month to turn around and catch 20%, 30%, 40% returns. In fact, we had 1 month with a 60% return. Now again, gold market's tiny, $6 trillion. We're not going to go bet the whole farm on gold. It can be easily manipulated to the downside and is often manipulated. So it makes sense to have a small allocation to it to essentially hedge against the risk of inflation. What happens if we get inflation? The banks have to raise the rates. Then you get the bond and stock crash at the same time. Now there's nowhere safe to hide, and that's when you see something like gold really skyrocket. Now, usually these bond markets and equity markets can sniff out inflation way before it actually happens. And that's why you're seeing such a nice run up in gold this year. For those of you who want to trade the least and aim for the highest return, the catch is you may have the most drawdown. And that's because we're trading a single stock or a single targeted ETF on Tuesday instead of something that's extremely diverse like the SPY ETF. And so the SPY ETF represents 504 companies, so it's going to have a smaller return with much less drawdown. and it's also taking advantage of option expirations 3 times a week. With this setup, you're only going to trade Tuesday and Thursday and then buy and hold a piece of gold. And this setup costs the least to get going, takes the least work, and actually has by far the highest return. The Tuesday trade is currently outperforming our SPY program 2-to-1. Now, it has had some pretty big drawdowns to get that. So it's not like there's a free lunch just by doing that. So once again, if you want to get really in detail with this, Dean likes to call it your ecosystem. He's going to go through what are all your investments, what makes sense, what doesn't make sense, how can we reorganize what you're doing to make a strategy that's bulletproof, weatherproof for the current circumstances, which is a lot of uncertainty. We really don't know what's going to happen between U.S.-China trade war. It always looks like they're about to make a deal and then it collapses. And so we've had this roller coaster in equities. If it's made you sick to your stomach a few times this year, I don't blame you. Our strategy has had relatively low drawdown. Let's see. Let's take a look at our total return. Then I'll jump into the most recent content. Now, I do want to point out that will be positive. Just the way the software works, it will not show the profit for my put options on the TLT until after I close out those put options. And we've been betting down on the TLT, so we should have a nice return in that. Now, if I do go to the bond portfolio, you can see it's going to show a loss in September right now, but that's not a loss. So TLT is down 1.3% approximately in September, but we've been buying expensive put options and financing it with very expensive in-the-money call options. So we've actually been generating nice profits on this big downside move. So that'll get updated on Thursday. Here's a quick look at the buy and hold portfolio just to show you. So people ask me, are you worried about the sell-off in gold? Should I? In fact, one of my favorite clients, Murray, if you're listening, shout out to Murray. Murray does all our trades. He's got a 7-figure account doing extremely well. He's on top of everything. And he emailed me, he said, do you think we should sell some covered calls on our GDX? And I said, no. But, and then a day later, GDX sold off. So, should you have sold a call option to help reduce the potential drawdown? Sure, maybe for a week, but then what happens when GDX spikes 10, 20, 30% on the next big trade war news? Well, then you miss out on all the upside. So this portfolio, really, you cannot do any sort of call option selling if you want to catch the upside profits. Now, could you buy a put option from time to time to help reduce a little of the volatility in this portfolio? Sure. But it's 10% of the total portfolio. It's performing extremely well. And all of the stars are aligning for this to go higher. Unless we see the ECB really disappoint everyone this week and the Fed disappoint everyone next week, I'm very, very positive that precious metals are headed higher. Now, maybe spot price on gold gets a little bit topped out in this 1,500 range because central banks can simply just buy it up en masse and put a top on the price. But the miners, the GDX is the mining ETF, those are just companies who are digging gold out of the ground. And so they can turn a huge profit as long as gold's up in these elevated prices. So I definitely like GDX over GLD right now. And unless we see a major letdown from the central banks this week and next, I'm almost ready to actually get a little more aggressive in this part of our portfolio. Now, here's the Tuesday play. Really, the only big hit we've had was in December, where we lost 4%. But the very next month, the plunge protection team came in, and we had this huge 7.7% rally in our Tuesday trade alert, total return month over month. The only other month we had that high of a return was June. September, we're up 2.3. August was rough. The equities market got surprised by the Trump tweet. I was expecting the Trump tweet in July. So I was actually setting us up to profit from a down move in July. Market rallied way higher, so we lost 1% there. Then I thought Trump was going to kick the can down the road and just push this whole Trump or trade war off to the sideline. They came out of the G20 meeting saying China is going to, guess what, buy farming goods. That's what they've been saying for 2 years. They're going to buy farming goods. And so August was just crazy to trade. If you were a day trader and you're following the momentum, you might have walked out with some sort of profit in that month. And September has been pretty smooth sailing for us, mostly from Facebook. But we've been rotating on the Tuesday play between Facebook and Apple primarily, and silver. When things look too peachy, and it's been a while since Trump has ruffled anybody's feathers, that's when I like to rotate into silver in this portfolio. And so I'm expecting probably sometime around October to get us back into that. Now, on the other hand, if China says not says, but actually does buy some farming agricultural products, I'd like to jump on the bandwagon with Ray Dalio's, Drunken Miller, Jeffrey Gundlach, BlackRock, JP Morgan, all of them. Every big money manager around the globe is all in, or at least heavily invested in the ETF EEM. So that would be my hot pick for the Tuesday play if things seem like they're starting to go the right direction with US-China. But it's hard to really be convinced that that will happen because they continue to say they will do things and then not. So that's a look. Without a trade deal, as long as they don't start stabbing each other in the back, which I don't think they will do right now, I'm looking for Facebook to get to that $200 range before I want to rotate into Microsoft. And at that time, I suspect the SPY will be above 300. So the concept there is if we get a surprise escalation in the trade war, I'd like to own one of the least volatile stocks in the world that has the most money behind it, and that is, bar none, Microsoft. So at nose-bleeding levels, I like Microsoft right now. At sold-off levels, I really like Facebook for a number of reasons. It's somewhat not tangled with China. It has an absolute monopoly in their business model. They have this Libra project coming out next summer, which may cause some speculation in terms of driving interest into that call option market, which, again, we're not trying to buy call options. We're trying to find fools to sell call options to. So that's kind of what we're looking at for Tuesday play. And then meanwhile, the Monday trades are doing well. Again, you can see the same loss in July. We're up about 0.3% so far in September, a good start to the month. So as long as we keep that return extrapolated into the future, we'll hit that 1% goal for the SPY. Now, in total, overlap all the trades together, we only have one losing month to date. And that just goes to show you, you don't really need much more in your portfolio other than two ETFs, the SPY and the TLT. Now, throw in GDX if you think the central banks are going to be completely reckless with policy. And that almost certainly is the case, that they will be extremely reckless with policy, to the point that they're now all starting, even from Jamie Dimon, Ray Dalio, all these guys coming out with these little LinkedIn pieces and Bloomberg interviews talking about why we need to create better social nets. All that really means is they're saying, hey, look, I became a billionaire by being at the top end of the banking system, getting free access to capital, investing it, making all this money. Don't hate me. Don't raise my taxes. Instead, let's start up modern monetary policy and start figuring out how we can flow cash from the bottom up. So that I expect will happen in the next 12 to 24 months, slowly but surely, and eventually cause inflation, which is when the big party ends. We'll see how much inflation they will entertain before they start increasing the interest rates. Okay, let's look at the big news now. And any questions out there from our live attendees? All right, no questions yet. I do want to say one more time, if you have not activated your account yet, call Dean, expert trader, follows our program, does some of his own trades on the sideline. He's been doing this for something like 15 years. Very experienced. He can help you get your ducks in order and make sure you're following the program accurately and not missing out on any of our trade alerts. All right, let's look at the big macro data that's helping us guide our trade alerts. Okay, I like to look at the dollar index, dollar strong. To me, this is at the same time as our government's being reckless with the deficit. So we're creating these huge deficits, which is fine because we have the only positive yielding bond of all governments outside of a handful. So we represent some 98% of positive yielding debt. So as long as this dollar is strong and we have the only positive yielding bond, I think we're going to have no problem fueling America's debt binge for the foreseeable future. And then you take all that money that we're borrowing and pump it through our consumer-based economy. Well, guess what? You're going to have a healthy GDP print and your corporations are going to look healthy. So this chart tells me equities have a huge run to the upside ahead as long as, again, China, US don't start some sort of massive war amongst one another, which probably will happen. It just hasn't happened yet. Right now it's just kind of like a little cat fight. Okay, we've got the next most important thing. What are the banks doing with interest rates? Well, we saw 30 central banks around the world in the last 30 days drop interest rates and in some way or another start to buy up their own government debt. So they're expanding their money supply and they're lowering rates. This is what China's doing because China's done it. Now all of their trading partners have to do it. And that is just spreading around the globe. So my expectation is just a tiny little 25 basis point cut next week. But I actually think that's probably the most bullish thing they could possibly do for the U.S. stock market, the U.S. bond market, and the dollar. Maybe it's not going to help our exports, but America is not a huge exporter anyways. And so, you got to ask yourself, is this dog and pony show between Powell and Trump real? Do they really hate each other? Or are they just trying to give us a show so that we all sit and watch and let them continue to funnel trillions of dollars to the banking cartels and make billions of dollars and bail themselves out? So it's hard to say what exactly is going on there. I'm also always concerned with the supposed hatred between the media and Trump, which also concerns me. So on the other breath, if the Fed were not to lower rates by 25 basis points next week, I would be very concerned. So that's kind of what I'm looking for with our central bank and interest rates. And so I think we still have a little more of a downturn ahead for the TLT. And so we'll continue to play that same setup on that. Now, if we do go to the live... real quick, I do want to show off this. We have found that most people who do order our program are already quite experienced options traders, so they can easily take the trades, manage the trades, get in and out. No big deal. A lot of people, though, they have the capital, they're sick of watching their portfolio going up and down, but they have no idea really what options market is or how these different strategies work together. So we've decided to create a 16-week retirement income bootcamp. Now, in every email we send out, you'll have a link to get to this bootcamp. And it's not some sort of bootcamp that it's one and done. Either you got it or you didn't. This is a bootcamp that repeats itself 3 times a year. So that means you can take the materials and do it over and over and over and over again, not just once, not just twice, but literally as long as we run this bootcamp, you can take it an unlimited number of times. And the goal of it is not to turn you into an options expert, not by any means. My goal in 16 weeks, and this is with a 2-hour live webinar every Tuesday. That's followed up with an email I send out with basically, here's what you need to get done. Plus, here's a test. I need you to reply to that email, answer the questions, and then I'm going to grade it. So that's the kind of the flow. Is it's a 2-hour lecture that's live and interactive on Zoom, recorded, and sent out to you with the recording. On top of that, every Monday, we're doing a catch you up Q&A. So if you did not understand something about the last week's materials, every Monday there's 2 hours slotted for nothing except just chatting with you. So if you're joining the boot camp a little late, or you just had trouble with a certain module, it doesn't matter. We're going to get you caught up every Monday during that period of time. Now, on top of that, at the end of each boot camp, we're going to invite you out to Albuquerque, New Mexico to trade live. Now, again, our trades take about 2 to 3 minutes, so it'll be mostly just hanging out together, but I want to watch over your shoulder and watch you put the trades in and make sure you've done it completely accurately. So that will be a live in-person experience on a Thursday and Friday. So we'll trade the TLT together on a Thursday, and then we'll trade the SPY together on a Friday. Here's just a quick overview of what we'll learn, and then I'll jump into today's content. So week 1 is the big picture. Why you only need 4 ETFs for the rest of your life. That's really the SPY and the TLT are the core 2. We like GDX if we think the central banks are being reckless. And then you gotta have that hedge, that what if those darn commies in China have a better setup than we do here in the West. So you gotta have EEM at least on your radar. I'm not ready to be long EEM right now. We did talk about why I might play it on the Tuesday play. But you got every big billionaire under the sun loading up on EEM, from Ray Dalio to Drunken Miller to BlackRock, the biggest mutual fund in the world, managing trillions of dollars. So there's a ton of money betting on EEM. Now again, I don't think EEM is going to fare well if they're in the midst of a U.S.-China trade war, because America's far stronger in all aspects in the short term to fight that war. So we'll see how that all plays out. But week 1, we're going to really just learn what are the 4 core ETFs we need to know about, and how are we using the options market to protect our assets and generate income. Plus, I'm going to get you hooked into the same Twitter, YouTube, and news sites that I follow, so that if I were to suddenly disappear, you'd have the same set of news coming to you that's pretty easy to digest. YouTube is great. Twitter's great. It really boils down the information into smaller, easier to grab nuggets, and it's all free on Twitter and YouTube. So I can show you how to get the macro view quite well without even having me to do the work for you. And again, you will get a take-home test. You email me back. It's got a to-do list of things you need to do plus a test, and I'm going to grade your work and send it back. So that's the format of each week. If you miss a week, it's not a big deal. You can catch it up in the recorded membership area, and also we can talk about it every Monday during the Q&A. So if you need to catch up on some materials, plus the whole boot camp repeats itself 3 times a year, so you can take it over and over again. Week 2, we're going to focus on how to place the trades in Interactive Brokers. It's by far the best broker for what we're doing. And there's even going to be a little piece about how to short the Chinese currency. So that's something that's kind of unique and not taught many places. Week 3, we're going to focus on call options, primarily selling call options, how to do it. This will be a lot of kind of grilling live, so we're going to be testing your knowledge live in the webinar, figuring out who gets it, who doesn't, sending you home with the homework so you can make sure you completely understand it. And this is actually going to be 2 weeks of content. So it'll take 2 weeks to really get you inside out knowledge of everything you need to know about a call option, buying them and selling them. We prefer to sell them 99% of the time, but sometimes it does make sense to buy call options. Week 5 and 6 are all about put options. Okay, again, the first week will mostly be about buying put options, because that's the main thing we do, is we protect the downside by buying puts. Every once in a while, you may want to sell a put option. So we'll talk about how that could potentially be used. After that, we're going to jump into what we're really doing is combining put options and call options together to form what we call an option collar. So week 7, we'll talk about a tight collar, which is where we may think the market's going to trade in a range. We want to generate money and income in a flat market. You need a tight option collar to do that if you want to do it safely. Now, a loose collar is what we've been doing most recently, where we expect the asset to actually go up rapidly. So we just want to have that downside protection and not miss out on some of the biggest moves in those assets. So that's what a loose collar does for us. And that's what we've been doing on Facebook. Now, on the TLT, we've been doing an upside down collar. Week 8, you're going to learn what the heck that means. Essentially, instead of selling an out-of-the-money call and buying an out-of-the-money put, we're going to be selling an in-the-money call and buying an in-the-money put. And that's how we were generating profits over the last 2 weeks, betting down on the TLT. So that'll definitely be something you need to know in different market cycles. Okay, how to safely get your hands on crypto. I don't like Coinbase or Binance because the education you're going to need is just tremendous to do it safely. Robinhood app is good for just buying a tiny bit of Bitcoin, a tiny bit of crypto, because it's got the technology to protect it on your phone. You're not actually owning the coins, you're just owning a proxy to it, so you can cash in and out super easily. And again, GDX may double in the next 12 months. Bitcoin might go up 2 to 3 times. Ethereum might go up 5 to 10 times. So we're recommending tiny positions in Bitcoin and Ethereum right now, as long as we think these central banks will continue to be reckless with monetary policy. So week 9 will get you into that. Week 10 and 11 and 12 are going to be how to trade like a hedge fund manager in terms of organizing your information like I do. So if you want to have your own spreadsheet that's filled out and has every single trade organized so you can see your monthly return, you can see your profit loss on the stocks, on the options, broken down by short options and long options. You get this exact spreadsheet. You get the 3 weeks of education on how to fill it out, and you're going to be able to trade really like a pro, even though you have such a simple portfolio. And if you do go dig into someone like Ray Dalio's portfolio, you'd be awfully surprised how close it is to what we're doing, except he's managing $144 billion. So just goes to show, even the most successful hedge fund manager of all time is utilizing a very simple setup, something like ours. Now, sure, he's trading a global portfolio, but at the end of the day, it's not a lot different than what we're teaching here. So we've got 3 weeks to get you up to date on the spreadsheet. We'll be filling out all the trades over the 3 weeks into your spreadsheet, so you'll get a good feel for all the trade alerts, how they flow into the spreadsheet. After that, we'll talk about, well, what about a financial crisis? Do we want to just sit there and do upside down collars on the SPY and the TLT? Or is there some easier ways to leverage our portfolio? And sure enough, there are some nice products out there in the ETF universe that will make your life a little easier. So sure, we do want to still own the SPY and the TLT, and we want to do those upside down collars to make safe profits to the downside. But our buy and hold portfolio is suddenly going to start looking at maybe it's not just gold that we want to own. Maybe we want to own the Yang, the SQQ, the SDAO. These are bearish ETFs. Maybe we want the TBF. That's something that profits if the TLT goes down. And at some point, once everything does get reset, stocks are lower, interest rates are higher, well, gold will be on its peak and ready for a massive crash. So eventually, even dust, the 3 times inverse gold miner ETF, can come in handy. So week 13, we'll talk about what we're going to do when a financial crisis does hit. That may be quite a ways off, but you never know. So that's just something we need to have in our arsenal of weaponry. Okay, what about after a financial crisis? Well, there's nothing wrong with the SPY, EEM, or TLT in the aftermath of a financial crisis. So what happens in a financial crisis? Probably Stocks get blown out, they crash. The bond market has a last hurrah, then crashes right after, and then the interest rates start to hike back up. And then that's when finally you get your crash in gold. So after we do have a complete global reset, there are some better ETFs we can rotate into to make our lives a little bit easier. And so that's what week 14 will talk about. The last 2 weeks are very advanced materials. Now, in terms of really being an advanced options trading course, this would still be classified usually as a beginner level lesson. But our portfolio is designed to be super simple. We don't want to make life more complex. And when I study some of these pro traders out there, the newsletters I follow, they're super clever about how they take advantage of the option market to do all kinds of crazy strategies. But at the end of the day, you could buy a simple ETF, sell a call, buy a put, and get the same result without having to rack your mind around all kinds of complex formulas and options strategies that you might mess up. So this is where the course ends. We're going to talk about how to do a credit spread and a debit spread, 4 variations of it. This is primarily for making very aggressive directional bets in the market, which again, that's more of a talent for a speculative growth portfolio and much less for a safe income portfolio. Can it come in handy? Sure. So we definitely want you to learn that. We have used it to help juice up the profits on the TLT by taking some profits and doing some bull call spreads on GLD. We did make some nice profits on that. So it's definitely something that's worth knowing, and that's what we'll cover in week 15. Week 16, writing put options. That's a popular question. People ask me, well, why do we have to buy the SPY? Can't we just get around it synthetically? Well, in week 16, we're going to talk about naked put option writing, why we don't use it, but how you could, and how it could fit into our strategy once you're very, very confident with the options market. The best way to use naked puts is really just if you want to get a stock at a discount, sell a put until you get filled into that position. So we'll talk about that and also some primary differences between owning the asset and selling a covered call versus just holding into cash and then using that cash to be able to sell puts. So put option writing is a popular strategy by huge banks who have gigantic portfolios, and they spread the risk on literally hundreds of different securities. So we'll cover that, and then that's it. Then the course repeats. So if you don't feel like you picked up 100% of the materials the first go through, don't worry, it's going to repeat itself over and over and over again. Now we're going to take some small breaks. We're going to take a little, so if you do go to the Bootcamp page, you can see the calendar. And so you can see I have a break scheduled for Christmas week and New Year's week. But other than that, there's really no other breaks in this first bootcamp coming up. And so the first class begins October 1st. So again, if you are interested in getting a world-class education for generating retirement income, you're not going to become a master options trader of all strategies because it's almost an unlimited education. But if you just want to master the art of pulling out income from the SPY, the TLT, this is the boot camp that's perfect for you because that's all we're going to talk about. You won't learn a thing that's not required to follow our trade alerts. Okay, so let's go wrap this webinar up and take a look at the content I've collected, which again, if you did take the boot camp in the very first week, I'm going to connect you to the exact Twitter accounts and YouTube channels as well as news sites that I follow on a daily basis so you can get plugged into the same information. What I'm giving you is really just a short summary of that. Okay, Nomura, hilariously, nobody watched Financial TV or Joe Schmo, retail investor looking at simple index returns, would have had any idea of the calamity occurring under the market surface yesterday. So we had a bunch of, well, here's the article. The momentum index products were crashing yesterday and today. Surprisingly, Facebook didn't get hit very hard by that, or the SPY. A little bit of a sell-off, not much. And so lots of news coming out about that today, about all these growth stocks getting hit. I think it's just a little sell-off. We're seeing banking stocks rally really hard today. So if you do go to the YouTube stream and you want to read all this stuff, you can click on it, and I have all this saved here. A whole bunch of information about this momentum-based indexes puking their brains out over the last 48 hours. Now, it's interesting because we're seeing a lot of money rally into things like the financials and the utilities. But if we're going to really be lowering rates for the next year, that's negative for banks. So I'm skeptical to jump on the bandwagon with that trade. I think it's just a little rotation, and expect the top of the SPY, the top companies with the biggest positions, to continue to dominate. Because of the same things we've been talking about. They have the access to the credit for near free. They take the credit, they buy back their own stocks. So it makes sense that that trend will not break until rates go up. And until rates go up, this credit cycle continues to fuel the stock market. Now, here's some interesting. China is very restrained on the trade war and other issues. I actually think there are many fervent racists and imperialists in the current U.S. administration. Wait. Sorry, I jumped. Fervent racists and imperialists in the current U.S. administration. They are undermining world peace, bringing great uncertainty to the 21st century. Okay, then we have China CPI is rising, so inflation is rising in China, which makes sense because they've been devaluing their currency. That makes the cost of goods go up because money supply is expanding. So each yuan is worth less, so the prices go up. Very simple. Same thing why we're seeing the U.S. stock market go up. If everybody else, has $10 bills and they pretend like they really have 20, well, that's going to double the price of anything that's not messing around with its money supply. So we're seeing lots of inflation, especially in food. China is plagued with lots of pollution. Perhaps that's why they are having such a hard time with their pork supply. Huge inflation here. So we're seeing a good reason for China to potentially purchase agricultural products without really looking weak, because their country really needs the food. So I think there's a chance that they buy some food, but they've been telling us this for quite some time. Here's that inverted yield curve. Watching out for it to steepen. That's usually the real signal for a crash. When it first inverts, that's when we usually get a big bubble, because now there's free money everywhere and it just starts to speculate into stocks. China's growth rate continues to get re-rated lower and lower rapidly over the last 9 months. So the question is, how much pain will China really take before the U.S. gives, or vice versa? How much pain will the U.S. dare to put on China with that before risking putting itself into a recession? Here's a list of some events. This guy's got a great YouTube channel, Daily FX. He trades Forex. We're trading primarily stocks, but he's really on top of monetary policy especially. So I do like to listen to that YouTube channel. It's one of the channels you'll get on our Bootcamp. Trump did a rally in North Carolina last night. Only reason I try to get clips from there is to see if they give us any kind of hint as to what policy will be regarding to China. Everything he's done in the press that's been publicly, he definitely focuses on the U.S.-China trade war. So I don't think it's going away, and quite frankly will most likely accelerate as we get into the next couple months. So North Korea fires 2 unidentified projectiles. Here's a look at the stocks I'm following. So EEM is supposed to be emerging markets. It's really just China and China's trading partners. and it has a huge amount of capital behind it. I think if the trade war does really escalate, this can go much lower in EEM. But if they come out and say we're going to buy some farming goods, I will probably put EEM into our Tuesday play. So we're watching that carefully. They've been saying they'll buy agricultural products for 2 years now. So believing that is risky. Okay, GDX, a little bit of a sell-off. This was up in the 30 range. I'm not worried about it. Buy the dip, 10% total risk in this position. Makes a lot of sense. If we get a disappointment this week or next, might reconsider that position size, but I highly doubt that we will. So we'll see in the next few days what the ECB does and what the Fed does. Okay, we got HYG. This is interesting with the sell-off in these growth stocks and momentum stocks. We're seeing a bid in the Russell 2000 today. Now, if we can get the Russell 2000 at a healthy chart and back towards new highs, that would make me think that we're actually out of global slowdown territory and maybe entering a huge new leg in the stock market. So that's something to watch. Russell 2000 has been very weak to date, so it's just kind of interesting to see it's having a bid today. Bank of America up today, which is interesting, whereas everything else is down a little bit. That we track. These, again, are the biggest companies in the SPY ETF. So they have the most automatic purchases just from the SPY. They have the best credit ratings. These are really the best companies at this point in time to be long when the future is so uncertain. So Bank of America, I was looking at today quite a bit. It had a nice rally, something like 10% from the low in just the last month. But it's very odd because even though it is maybe selling at a discount, the headwinds against the banks are very clear. We know that the banks are very likely to drop interest rates. That makes it very hard for banks to generate a profit. Just go look at Deutsche Bank in Germany, who's been fighting negative rates for considerable time. They're near bankrupt. So I'm not jumping on the bandwagon to chase financials yet. Here's Facebook, our Tuesday play again. I'd like to ride it towards 200 when I expect the SPY will break above 300. At that point, we'll most likely go to Microsoft, let it ride a little bit longer, and then go to SLV. Now, if we do get China really buying agricultural products, I may flip us to EEM. Here's that Bank of America chart. General Electric, interesting stock, one of the most highly traded stocks in the world. And it has the biggest amount of debt of almost any company in the investment grade bonds. I think it actually does have the most debt. So this is a critical stock. If this goes under, the whole credit market might be in some serious trouble. IWM, there's the Russell 2000 chart showing a little bit of strength. Here's our SPY, which I suspect will be above 300 in no time, most likely around next week when the Fed announcement hits. GDX having that sell-off, so it's down about $3.20. I'm not sweating it. Again, it's 10% of our total portfolio, so we lost 1%. But that portfolio is up some 200% this year, so it's not a big deal. TLT having a little bit of a sell-off. I don't think that's the end of the bull run in TLT. I think it's going to go higher as long as the trade war persists, which I think it will. Here's that chart on EEM. So you can just see the massive volume picking it up in the last year. And it's really ready to pop into new highs if it can get past this trade war dilemma. So we'll see if that can happen. If not, it may break down and test these 2016 lows way down at the $30 level. VGK is a Europe ETF by Vanguard. I was just curious to see how old Europe's holding in there with Brexit. Some Seeking Alpha little clips about what the ECB is going to do. All kinds of rumors. They're saying they're going to lower rates and pay 50 billion a month towards in euros, not in dollars, which used to be more dollars, but their conversion rate's been sliding. So we'll see, but that would be huge stimulus, especially if we start getting other banks of the same size doing the similar. Chinese currency against the dollar has sold off. I think this is going to $8 or $9 if the trade war continues to escalate. So we'll be looking at how to teach our folks in our boot camp, at least, how to play that. But yeah, I think this is just a short-term sell-off in that, which is also supported by the strong equities sell-off in bonds. We've seen that this will move before equities does. So we've had a pretty good alarm bell go off. Every time this conversion rate rockets a little bit higher, there's usually been some pain in equities almost immediately after, and then a rally in bonds and gold. So I don't think this trend's ending anytime soon. Here's your 5-year chart on it. So 2015 and 16, they had a similar problem just on their own because their growth was slowing down so much, and they went ahead and printed trillions of dollars and took out lots of debt and started building more stuff that nobody needs. Started to crash again in 2018 when they tried to protect their banking system by cleaning up, and everybody tried to clean up their banking system in 2018. That's when we had 98% of all assets lose value, and now they're back to the same predicament where they need growth. It's crashing. They're out of credit. So we're seeing the weakness in their currency. So this problem was never fixed in 2015 or 16. They made it worse all on their own, and now the U.S. is coming and putting tremendous pressure on China. So that could be devastating to China's economy and to their currency in the upcoming years. Here's the euro, slowly but surely losing its value. And if they really release a bazooka of stimulus, this will probably continue. I like to use the German 10-year bond to try to predict the U.S. bond market. And so a little bit of relief in the yields on that, but I suspect it will go lower as long as the trade war escalates. Same thing with the 30-year Treasury, which is one of the main assets in our TLT. Gold's selling off a little bit, not worried about it. I think that this will bounce around in this level as long as the trade war escalates, plus as long as central banks are reckless with policy, which seems to be the case. Almost certainly, we're seeing crude oil pick up in price. If it gets too expensive, like above 70, that could be an alarm bell that inflation expectations are going to go up, so those bond yields will rise. And that's what we saw in 2018 was the yield on the 10-year got above 3%. All of a sudden, it was crazy to buy the stock market when you get 3% from a 10-year Treasury. So we don't want those yields getting so competitive that it pulls all the money out of the stock market. Silver, again, selling off, but I think the rally in silver's not anywhere near done. I'd like to play that on the Tuesday play with the put option below because it is a super risky asset, and then sell call options above for income. I just think we're a little early to do that. I think the stocks are going to go towards 2 new highs before we'll want to take that risk. Now, surprisingly, Bitcoin and even Ethereum are holding their ground relatively, not selling off compared to gold or silver. And again, this represents a 1% position on Bitcoin and another 1% in Ethereum in our total portfolio. So Bitcoin, I think, could potentially double, triple, quadruple, and Ethereum could go up 5 to 10 times if the trade war really does escalate and these banks really start a massive QE program. All right, guys, that's a wrap for today's presentation. I'll end you once again with Dean's phone number. Call Dean, expert trader. He's been in the game for over 15 years. He's made a lot. He's had his bad days too. He follows our program. He also does his own trading. He can look at your ecosystem, figure out what makes sense, what's way too risky, what's missing from your portfolio, and get you started following our program. So call him now, 505-322-7515.